Welcome to Market Movers. I'm Jim Murio, and today we're talking about bank earnings. Joining me is Scott Martin.
Hi, Jim.
Scott. So, okay, next week, the 14th, 15th, 16th, and 17th, we have Citibank, JP, Goldman Sachs, Morgan Stanley. In the last couple of weeks, maybe even months, people have been kind of dialing back earnings estimates. We've had such a great run. Does it continue with the banks?
It probably does, in the sense of, you made something interesting as far as a point there, Jim, in the sense of like this whisper talk now of peak earnings being done, of maybe this being that guide down quarter because of the tariffs, because of maybe the slowdown in economic data. Maybe this is the quarter that the market actually sees that come to fruition.
Okay, we know banks want higher rates. They've gotten that a little bit, but they also kind of like a steeper yield curve too. They've not gotten that at all. Does it matter they've gotten somewhat higher rates?
It does in a little bit of a sense, in the degree that the interest rate curve is something that's already happened, right? So if you're a bank and you're talking about other things that influence earnings, which is obviously trading revenue, loan demand, those other things still look okay to me.
Okay, good. Now, before we dive into our trade discussion, I'd like to point out with all market movers, these are trade examples, not recommendations in any way. Markets and prices are going to move. Scott.
Yes, so today, Jim, looking at the S&P 500, obviously, and seeing how much volatility has been out there, my friend, and some of the options prices that have really gone wild, in my opinion, over the last week or so. And I believe giving us a little bit of an opportunity here in the sense of how the market has moved and maybe some pricing that I think is actually interesting. So specifically today, Jim, looking at buying the week 3 January 25.25 put spread for about 4 ticks. This trade risk 200 to make potential 1050. It has the ES underlying at about 25.81. The trade expires January 18th. The reason that I like this area, Jim, if I was looking to put on this expression, maybe just a little bit of a bearish hedge, if you will, is I believe this market's overdone a little bit. I think it's run up quite a bit off the lows in, say, December. And the fact now that we have maybe a little bit of a retracement coming in ahead of these earnings, which are coming out, as you mentioned, just in light of the fact that maybe this is that down quarter that the market has been looking for as far as earnings reports.
Okay, we're at 2580-ish right now. 20 ticks below what a lot of people are talking about is that 2600 level's importance. Did that come into your thinking?
It did, and that's also that 50% retracement that we talked about on MM that was off that low in December all the way up to, say, those highs back in early December.
I like your trade. Mine's different. I've been looking at that 2600 level too, and I actually priced out a call spread because I think these banks, now that we've watered down estimates, perhaps they're going to surprise to the upside. So I'm looking at buying the week 3 Jan 2625, 2650 call spread for 6.5 ticks. So it risks 325 to make 925. Also expires the 18th, like we said before, 25.81. And now I'm thinking about mine and thinking about yours. To think that the stock market could be up or down 100 ticks is nothing. It's been doing that almost every day. Both of them seem good to me.
Both of them seem like pretty good expressions, especially on a risk-reward basis, and just given that volatility, Jim, that I think is still going to be out there regardless, because this is a market that is a lot pushing and pulling on it, whether it's tariffs, whether it's government shutdown, earnings, as we've already mentioned, economic data has started to get a little bit wonky. So to me, these are both expressions that maybe are viable.
Okay, last quick question. It seems to me we've boiled down earnings season basically to bank earnings and to tech earnings week. Which is more important? I think I know what you're going to say.
It's tech earnings, because tech has been leading this market all along the way, and both on the upside and downside. I mean, tech also brought us down, say, in November, December. I believe that's what the market's looking for, some leadership one way or another.
1A is the bank
Very
earnings.
close second.
Thanks for joining us on Market Movers. I'm Jim Murio, where we're helping make you a better trader.